Welcome to the deep dive. We take your source material, your reading stack, your research pile, and really cut right to the core of what you need to know.
Yeah, get straight to the good stuff.
Exactly. So today, we're diving into the future of digital assets. And it's kind of a tale of two cities, isn't it?
It really is. You've got this very formal, regulated, institutional adoption story happening.
Right, the tokenization wave.
Precisely. And then you still have the other side. The, let's call it the crypto frontier. Still chaotic, still high stakes.
Okay, so that tension is pretty clear in the source stack you send over.
Absolutely. It's the central theme. We've got material on, the rise of tokenized equities, these major new stablecoin laws in the US and globally finally kicking in.
Landmark stuff.
Definitely. But then we also have these, frankly, stark reports about the risks still out there. The scams, the bad actors targeting consumers, transparency versus risk.
Okay, let's unpack the institutional side first. The big money play. Tokenized equities, TAIs. It feels like the momentum is serious now.
Oh, it is. Look at something like Token 2049. You mentioned 15,000 people showing up.
Yay, huge crowd.
And what was the main buzz? Not just Bitcoin, not NFTs this time. It was tokenized equities. That was the big conversation.
So why T's? Why is this the focus?
Well, it comes down to a lesson learned, a big one from the last cycle.
Yeah.
What was the first real product market fit after Bitcoin itself?
Stablecoins.
Yeah.
Tokenizing the dollar.
Exactly. And why did that work so well? Because the underlying asset, the US dollar, is just incredibly liquid. Price discovery. It's a dollar. Always a dollar.
Right. Easy.
Super easy. So that base liquidity made bootstrapping adoption on-chain, well, relatively straightforward compared to trying to tokenize something illiquid.
So the playbook is find another super liquid, easy to price asset and tokenize that.
That's the core idea. Yeah. So the principle behind tokenized equities, TIEs, is basically taking that stablecoin lesson and applying it. We're talking about tokenizing assets that already have deep liquidity and really solid price discovery in the traditional world.
Like big, actively traded stocks.
Exactly. Think Tesla. Think Coinbase shares. Stuff that trades in huge volumes already. We don't need to create demand out of thin air. We're just upgrading the plumbing, the access rails.
But the sources suggest this is more than just, making trading a bit slicker. It's positioned as the only way crypto scales massively.
It kind of is, yeah. I mean, look at DeFi today. Market cap hovering around, $3 trillion, give or take?
Something like that.
If the ambition is really to get to $100 trillion, you simply cannot do that on purely crypto-native assets alone. You have to bring real-world assets, RWAs, onto the chain.
And public stocks are the giant pool of RWA value.
The biggest and easiest target, yeah. Globally, public equities are something like a $120 trillion market. Tokenization is the bridge to bring that value on-chain.
Okay, so who's actually adopting this? The sources mention three main groups or verticals.
That's right. The first one is all about accessibility. Think about places like Latin America, parts of Asia, Africa maybe. Getting reliable, cheap access to, say, US or European stock markets can be really tough. Slow, expensive, lots of red tape.
So T's give them a direct line.
A direct, often cheaper and faster route to global equity markets. Huge demand driver there.
Okay, second vertical.
That's the crypto natives.
Right.
The generation that basically lives on-chain already. They expect everything to be 247, instant settlement.
And composable. That word keeps coming up.
Composability is key for them, yes. They don't just want to trade Tesla stock. They want to use tokenized Tesla stock as collateral in a DeFi loan instantly, or pair it with tokenized gold to create some new synthetic product.
Like digital Lego bricks for finance.
Exactly. You just can't do that easily, or sometimes at all, with traditional brokerage accounts. They prefer the token rails. They feel archaic otherwise.
And the third group, the big one, potentially.
The U.S. institutional market?
Yeah.
Hedge funds, big brokers, asset managers. This is the slowest burn, probably.
Why slow? They stand to gain a lot.
They do, but they also have massive investments in the current infrastructure.
Yeah.
Network effects are real. But behind closed doors, they know their systems are old. The plumbing, the securities rails, a lot of it dates back to the 1980s.
And the sources use pretty blunt language. They suck.
Well, yeah. Think about settlement times. T+2. You make a trade, it takes 2 days for the actual ownership in cash to settle.
2 days of risk, capital tied up.
Exactly. On-chain, settlement is near instantaneous, maybe seconds or minutes, depending on the chain. That capital efficiency, when you're trading billions, it's enormous. They can't ignore it forever.
Okay, but safety is paramount here. The sources are clear. This isn't like the synthetic tokens that blew up before.
Absolutely critical distinction. This has to be regulatory grade.
Yeah.
The model demands one-to-one backing, full collateralization. No more synthetic games like Mirror Protocol tried or, FTX's attempts.
So how do these platforms make money initially?
Mostly fees on issuance and redemption. Simple enough. Down the road, maybe they could earn yield by lending out the underlying equities.
Ooh, risky.
Potentially, but only if it's done very carefully. Fully collateralized lending, transparently managed on-chain, audited constantly. Think something like how MakerDAO handles collateral, but for equities. It needs to be incredibly robust.
Right, which brings us neatly to regulation. If you want that $120 trillion equity market on-chain, you need serious guardrails, and it looks like they're finally being built.
They are. This is the necessary quid pro quo for institutional adoption, and the cornerstone, at least in the U.S., is the Genius Act.
The Guiding and Establishing National Innovation for U.S. Stablecoins Act. Quite a mouthful. Signed July 18th, 2025.
Yep. And it's huge because it provides the first proper federal framework just for payment stablecoins. That sets the tone for broader asset tokenization.
What are the key takeaways for someone just using, say, a dollar stablecoin?
Yeah, clarity first and foremost. The Act makes it clear. Stablecoins from these approved issuers, these PPSIs.
Permitted payment stablecoin issuers.
Right. They are not securities. They are not commodities. That's massive for legal certainty. Second, and this is crucial for safety, PPSIs must hold 100% reserves. Identifiable reserves.
And only specific types of assets.
High-quality short-term stuff only. Cash, U.S. Treasuries mainly. No junk bonds, no crypto assets back in the dollar stablecoin.
And critically, no rehypothecation. Explain that one.
Yeah, that's vital. Rehypothecation is basically when the custodian uses the customer's assets, in this case, the reserves backing the stablecoin for their own purposes, like lending them out again to make extra profit. It creates hidden leverage and risk.
Like we saw with some exchanges.
Exactly. The Genius Act flat out prohibits it for these reserves. They have to be segregated, identifiable, and available. Holders also get a legal right to redeem their stablecoin for dollars, one-to-one, on demand.
Got it. Now, there's another interesting constraint I saw about interest.
Ah, yes. Very important detail. PPSIs are explicitly banned from paying interest or yield directly to stablecoin holders.
Why? Seems counterintuitive.
The goal is to keep them purely as payment mechanisms, like digital cash, and not let them become deposit-like accounts that compete with regulated banks. It protects the existing banking system structure.
Okay, that ban on yield is going to force some creative thinking down the line, I bet. We should circle back to that. But this isn't just a U.S. thing, right? Regulators everywhere are moving.
Yeah, definitely not. It's global. The EU has MiCA, its big crypto framework. It makes careful distinctions between different types of tokens, asset reference tokens, e-money tokens, and imposes strict reserve rules too.
And Hong Kong?
Hong Kong's stablecoins ordinance went live in August 2025. They set a really high bar, like requiring HK $25 million in paid-up capital just to get started, plus full backing, plus potentially over-collateralization. Everyone sees the stablecoin tokenization wave coming and wants robust rules in place fast.
Okay, but regulations are one thing. Can these on-chain systems actually deliver better transparency than traditional finance? TradFi has decades of audits, examiners.
The different kind of transparency, often much faster.
Yeah.
Take a platform like Backed Finance, mentioned in the sources. They use Chainlink Proof of Reserve.
How does that work?
Basically, Chainlink technology gives an independent third-party secure direct API access into the custodian bank, where the actual reserve assets, the stocks, the bonds are held. That third party then verifies the holdings and reports the data directly onto the blockchain, often daily. So anyone can go look at the smart contract and see cryptographically verified proof of the reserves backing the tokens updated every 24 hours.
Compared to waiting for a quarterly report in TradFi.
Exactly. It's near real-time verifiable transparency. In that sense, yes, it can be significantly safer and more transparent.
So, assuming the regulatory winds in the U.S. keep shifting, maybe less anti-crypto, these tokenized equities become the new base layer collateral for DeFi.
That's the promise. They become the fuel. Once you have reliable, regulated liquid equities on-chain, you can build the next generation of DeFi applications on top of them. Leveraging, composing, that's where the next big wave of innovation is expected. But, this is a big but, it's easy to get carried away with the institutional story, the regulations, and think everything's safe now.
Right, the sources definitely pull us back to earth on that.
They do. Because while Wall Street is building regulated on-ramps, the crypto back alleys still exist. critical thinking, caveat emptor, it's still essential. The Wild West hasn't entirely disappeared.
And we have some pretty specific examples of that risk from the Reddit material provided. Concerning an influencer, Levi Rietveld, marketed as a crypto wealth mentor.
Yeah, and the allegations there highlight really common scam tactics. We need to be clear, these are allegations reported by users, but they detail things like pushing generic, get-rich-quick stuff, charging $500 for, let's say, questionable advice.
Standard stuff, maybe a bit grifty, but it got worse.
According to one report, yes. Allegations of a phishing attempt trying to trick someone into giving up their wallet seed phrase using a fake airdrop link.
Oh, classic, the oldest trick.
That apparently resulted in the alleged theft of the user's XRP, Stellar, and Arlet. Direct theft via social engineering. That's still happening all the time.
Okay, so direct phishing is one danger. What about these crypto klepto schemes mentioned? That sounds different.
It is. This involves fake investment or trading platforms. The sources named Elite Traders Market, MediaYieldCapital.com as examples used in the alleged scams.
How do those work?
The scammer convinces the victim to deposit funds onto this platform, maybe starting small. Then, the platform shows amazing returns. Like, one user reported putting in $1,100 and seeing their balance shoot up to over $5,600 really quickly.
Well, it's incredible, hard to resist.
Totally, but it's fake. The numbers on the screen are just made up. The moment the victim tries to withdraw anything their initial deposit, the supposed profits,
Locked.
They get a message saying the account is frozen, or the initial investment was too small, or they need to pay taxes or fees first. And they demand more money to unlock the withdrawal, like asking for another $2,000 in that example.
The advance fee fraud.
Exactly. It's designed to bleed the victim dry before they realize the platform, the profits, none of it was real. The initial deposit is long gone.
What's fascinating and maybe confusing for people is that the same influencer, subject to these very serious allegations, was also apparently sharing his actual crypto portfolio publicly.
Right, and that portfolio included some legitimate high-performing assets. The sources mention RNDR being up over 500% year over year, CASPA up nearly 500%, plus things like HBAR, XRP, XLM.
So it illustrates this weird coexistence. Massive, real gains are possible alongside these predatory scams.
Precisely. The legitimate opportunity and the cynical risk live right next door to each other in this space. You absolutely have to be vigilant and discerning about which door you're walking through. #outro.
So wrapping this all up, where does this leave us? It really feels like we're at this major intersection, doesn't it?
Definitely a collision point. You've got this immense pool of traditional value, that $120 trillion in global equities starting to flow onto blockchains.
And it's flowing onto rails that are increasingly regulated, governed by things like the Genius Act, made transparent by tech like Chainlink Proof of Reserve.
Yeah, the institutional regulated side is getting serious, but as we just discussed, that doesn't mean the underlying volatility or the risks just vanish overnight.
No, you still see the massive swings like in CASPA or RNDR, and you still see the devastating personal risk from scams detailed in those reports. Both are simultaneously true.
Which leads to, I think, a really interesting challenge for the next phase of DeFi innovation. Here's the provocative thought.
Okay, let's hear it.
We know global capital is likely moving towards these tokenized equities. We also know that the key U.S. regulation, the Genius Act, explicitly bans the issuers of the stablecoins used for payments, the PPSIs, from paying yield. They have to be just payment rails.
Right, to protect the banks.
So the challenge is, how do DeFi builders create new, compliant, yield-generating products using this flood of tokenized equity collateral? They need to find ways to generate returns around that explicit ban on the payment stablecoin itself paying interest without breaking the rules or destabilizing the system.
So turning stable, non-yielding tokenized assets back into yielding opportunities, but safely and legally.
That's the next big puzzle to solve. How do you unlock yield compliantly in this new tokenized world? That's the mountain innovators need to climb next.
A huge opportunity, but wrapped in a complex regulatory knot. Fascinating. Okay, that's where we have to leave our deep dive for today. Thanks for joining us.